To unlock the potential of your property, you need a partner who can foresee future trends, help you innovate to stay ahead of the curve, and build your competitive advantage. We see the opportunities that will help you achieve your goals faster. Because success isn't just about keeping up, it's about leading the way. Our experts deliver fast, flexible and tailored solutions to realize your goals at all stages of your strategy, lending proven expertise with data-backed insights. We're here to accelerate your success. Let's lead the way together.
We see an opportunity to do what's right, to change business as usual, to become business as it should be, where people don't just live and work, they thrive. To do that, Colliers is committing to elevate the way we do business, to elevate the built environment. We will minimize environmental impacts in our own operations and through the services we provide our clients. We will increase diversity and inclusion in Colliers and across our procurement practices to create an atmosphere welcoming of diverse ideas and perspectives. We will promote health and well-being in our operations and through our client services to help improve lives. Together, we will elevate the built environment and build better for our collective future. For ourselves, for our clients, for our communities, for the world.
We are Colliers, a world-class diversified professional services and investment management firm. Backed by our enterprising culture and growth mindset, we're leading the industry forward. With new partnerships, new services, new technologies. With annual revenues of $4.5 billion, our momentum is unparalleled. Our experts reimagine the workplace. Find the perfect space. Design and deliver the best projects. Manage great places. Maximize return on investments. And elevate the built environment. Our success is made possible by our greatest assets. 18,000 professionals in 65 countries around the world, who drive exceptional results for our clients and are working to achieve more. More assets under management. More sale and lease transactions. More square feet managed. Accelerating your success. It's in our DNA. It's who we are. And it's what propels us forward.
To unlock the potential of your property, you need a partner who can foresee future trends, help you innovate to stay ahead of the curve, and build your competitive advantage. We see the opportunities that will help you achieve your goals faster. Because success isn't just about keeping up, it's about leading the way. Our experts deliver fast, flexible and tailored solutions to realize your goals at all stages of your strategy, blending proven expertise with data-backed insights. We're here to accelerate your success. Let's lead the way together.
Good afternoon, everyone. Happy Year of the Snake. It's my pleasure to welcome everyone here in Zoom for Colliers Q4 2024 Philippine Property Market Briefing. I am your host, Maria Cristarino Hoson, Senior Director and Head of Office Services, Landlord Representation. In Chinese astrology, the Year of the Snake is considered auspicious as it's a time for rebirth, transformation, and personal growth. And judging for what we've been hearing and reading lately, the Philippine property market is in for transformation this year. Whether to transform into something positive or negative, I guess we'll have to wait and see. But luckily, experts from Colliers will share insights that will help us navigate difficult times ahead and transform challenges into opportunities. I know everyone is excited to know how the real estate sector performed in the last quarter of 2024. And Joey has prepared a jam-packed program today as we will discuss office, residential, hotel, and industrial segments. So in the next 2 hours or so, we at Colliers will do our best to provide you insights, recommendations, and some assurance that will guide us through 2025. I would also like to ask you to scan the QR code displayed on screen. Joey will be flashing the results of the survey in between the segments. So with that, let's begin our briefing. In our last market briefing, we highlighted that the office sector avoided 20% vacancy despite negative net take-up due to new surrenders from POGO firms. We also noticed increased investments among occupiers, which resulted in office expansions and stronger demand in the provinces. The residential segment, meanwhile, saw lukewarm demand, prompting developers to delay new launches. However, leisure-themed developments outside Metro Manila continue to shine and attract investors. The hotel segment, on the other hand, saw the most positive development in 2024 with exponential increase in MICE facilities, all-time completions of hotel properties, and tourist arrivals doubling up. The industrial sector, too, was quite robust with more industrial developers modernizing their properties, sustained demand for cold storage facilities, and launches of industrial park within integrated communities. In other news, the U.S. elections are over, and we're waiting for a collective bated breath if President Trump's campaign rhetoric will, progress into a full-blown trade war with China. Locally, we anxiously wait our own elections unfold, and we wonder how this will affect the current administration's economic policies. Yet there's so much happening right now, but one thing is certain, 2025 will be anything but interesting. So to start, I'd like to call in my colleague Kevin Hara to discuss the office sector.
Thank you, Chris. Good afternoon, everyone. Okay. All right. Thank you again. Good afternoon. So for the office sector for 2024, in the past year, we recorded the first negative net take-up since 2021 at the height of the pandemic. So we monitored about 45,000 negative square meters of net take-up. The POGO exodus had something to do about this. But let's not forget that pre-pandemic leases or leases that were signed up just before the pandemic hit in 2020. Okay, so about the negative take-up now. So as I've said, the POGO exodus had something to do about this, but let's not forget about the pre-pandemic leases that were not being renewed in 2024. And it's a regular trend that has been happening since the pandemic happened and the market was shifting over the past 5 years. However, we do think that the drop in negative levels could have been worse if not for companies still expanding, still setting up in Metro Manila. So a little bit more on that later. Secondly, as anticipated, there was a slowdown in Q4 office transactions due to the US elections, mainly attributed to the elections, as companies put a pause on real estate moves during quarter. And we've seen this in past elections since 2008, where normally we've seen about 30% drop in the quarter where the elections happen. But we expect that to bounce back actually immediately in the succeeding quarter. That is this quarter, in the first quarter of 2025. So overall, we're not expecting the net demand to remain negative this year, as there is still a healthy amount of deals happening despite the POGO exodus, the POGOs leaving. But vacancy will remain elevated because of new buildings that were deferred from last year and will be completed this year. So I'll show a little bit more detail about that later. All right, so we ended 2024 with 19.8% vacancy. So as mentioned, 45,000 square meters negative net take-up. But 2024 was also where we saw a record drop in new building completions. So we just saw 182,000 square meters of new office space being completed. And that was the lowest since 2010. So while a drop in the new supply might have helped in reducing the vacancy rate overall, this was again effectively neutralized by the POGO exodus. And again, I mentioned the pre-pandemic leases not being renewed. So this year, as I mentioned, we're not expecting negative take-up for the full year this year. But we are assuming a conservative estimate of 150,000 square meters positive take-up. And we think any number above 150,000 needs to have big deals happening in the market, like what happened with government transactions in 2024. And of course, the POGO deals happening in past years. I talked about this earlier. So yeah, 150,000 positive. But the carryover of supply that was deferred from 2024 is actually going to be completed in 2025, and that will so we'll have a huge chunk of office space that will be completed this year. That will also push vacancy rates upwards of 20% to 22% actually by end of this year. Next slide. So we saw 260,000 square meters of POGO space returning to the market in 2024. But what we also wanted to highlight here is that leases are still not being renewed. The non-POGOs, BPO's traditional office occupiers are still surrendering leases that were signed up in pre-pandemic. These were leases that unfortunately were are at rents before the pandemic hit, so meaning they are above market. And usually occupiers take the opportunity to rationalize their leases and recalibrate their real estate strategy. And that includes, not ending or not renewing leases that are above market. And that's happening since the pandemic hit 5 years ago. So all in all, that's a 36% increase in vacated spaces year on year from 2023, and contributing to the 45,000 negative net demand. But the bright spot here, I would say, is that we still saw a decent amount, a respectable amount of deals happening in 2024 at 752,000 square meters. And that's purely non-POGO deals. So you have traditional and BPO still taking up spaces, still signing up deals. Because also part of the rationalization of the real estate is really to take advantage of the lower rents when you do relocate or expand into another office space. Next slide, please. So I mentioned that 45,000 negative could have been worse, no? If not, but because companies are still expanding, signing up because they're expanding and setting up in Metro Manila, this is helping mitigate the negative drop in net demand in the office market. So about 56% of transactions have a positive effect on net demand. And these really come for our ever reliable outsourcing industry and shared services sector. Next slide. And as you know, the US elections happened in the fourth quarter, and we weren't really surprised about the drop. So as I mentioned earlier, normally since 2008, except just for 2020, we normally see a 30% drop in transactions from Q3 to Q4 of an election year. But another trend what we've also seen since 2008, except 2020, is that the transactions usually pick up in the first quarter of the succeeding year by about 40%. So we're expecting, and we also see this actually in our preliminary data for January, that we're on track to be at normalized level 200,000 square meters in the first quarter, which is close to the average in the first 3 quarters of 2024. Next slide. And Metro Manila is still a traditional office market. So 57% of office deals in Metro Manila are from the traditional office market. And about 27% of the traditional pie is from the government transactions that happen mainly in 2024, mostly in the Bay Area. But we've also seen an uptick, significant uptick in transactions from outsourcing industry, the third-party outsourcers to be particular. That's from 194,000 in 2023 to 267,000 in 24. So that's a 38% year-on-year increase in that particular sector. So quite very substantial increase in that ever reliable office demand contributor. Next slide. So Bay Area leading in 2024, mostly primarily by the big government agency office deals that happened in 2024. But we still, in the fourth quarter, we did see some shipping companies like Anglo Eastern taking up space in the Bay Area. We've also seen increases in activity from major markets like Fort Bonifacio up 21%, Quezon City up 32%, even Makati up 7%, from traditional outsourcing and shared services. So J&J is domestic and shared service business. Ortigas, we just saw a decrease in year-on-year transactions activity primarily because of the higher base in 2023, where in 2023, Artigas was actually a top market of office deals. Next slide. So we saw really few new office completions in 2024, with only about 182,000 square meters of new buildings completed. Compare that with the 611,000 that were completed in 2023. So quite a huge drop from the previous year. This is because also a lot of projects that were originally slated for 24 were pushed back to 2025. That is why, next slide, please. We will see about 656,000 square meters of new office space completed or delivered in 2025. So, naipon sila in 2025. And then we do have we're going back to 200 levels in the next 2 years, ending at almost 500 by 2028. So, from 14.5 million square meters that we have this year, or by the end of 2024, we will have 16.1 million after 4 years. A lot of new buildings will be coming in QC, Quezon City, in areas like Araneta, Cubao, Bridgetown, North EDSA, and Vertis North. And we're also anticipating or looking forward to details on what will, from developers, on what will be happening in notable properties that we've probably seen in the news, like the Port Strip, MC Home Depot properties in BGC, even the IM property that was in the news here in Makati, and also the market, what will happen to market after the current leases ending, the land leases ending in 2027. So those are also things that we are monitoring and will add into the office pipeline as details become clearer over the next few months. Next slide. So as mentioned, even if we don't have a lot of new supply in 2024 and transactions have been happening in 2024, vacancies actually remain elevated in most markets because of vacated spaces. So we've noted here areas like Fort Bonifacio, Bay Area, of course, from the POGOs, and some areas in like Makati Fringe and Labang. So still contending with a lot of spaces that are returning into the market. Although as if you notice here, Makati CBD already well into the single-digit vacancy territory at 8.3%. So in total, we have 2.8 million square meters of vacant stock. So that is the absolute amount of the 19.8% vacancy rate. Next slide. So rents in 2024 overall still remain flat, if not still decreasing in some areas like Bay Area. But we are still seeing areas that slightly increasing rents, but it really depends on the situation of the building. Landlords still need to be very creative depending on their situation. Of course, seriously consider reductions or improvements in the commercial offerings if the vacancy is still high. And of course, and I'll discuss this a little bit more later, if there's previous tenant that used the space and they have still assets left in that space. Bay Area headline rates, as mentioned, they have a overall reduction in that area by 5% compared to the previous year. You may think that rents would have had a larger reduction in the Bay Area because of the ban last year for the POGOs. But we have to remember that rents in the Bay Area have actually dropped by more than 50% from pre-pandemic levels. It was really COVID that started the triggered the substantial reductions in that area, not really the POGO exodus, which just came into force really last year. In Makati, no, rents are starting to increase in some buildings, mainly due to the dwindling supply in that area. But lenders do have to remain competitive, especially if their portfolio is aging, and there's a lot of options in that market as well because of the sheer amount of space that's available in the CBD. So if we talk about, I mentioned Makati is 8% vacancy rate, but that's still about 280,000 square meters of office space. Okay, next slide. So vacancy still remain elevated overall. Rents remain flat overall, but there are still opportunities for tenants and landlords alike. So of course, for tenants really finding the good deals in vacated spaces. No? So these spaces may have some usable assets that can be used in their operations. And take the case of some areas in Metro Manila like Bay Area QC, where headline rates are lower by 40% than what you see in the CBD, even for fitted and semi-fitted spaces, because the common roadblock for occupiers right now is really the capex investment needed in the fit out. So anything that the landlords can do to participate or help contribute to covering that normal business item would be helpful in gaining more traction for their buildings. So for a landlord to enhance marketability of these vacated properties, we recommend exploring refurbishing, renovating, or reinstating even vacated spaces, especially if it was a POGO operation in the past. If not, really just a standard or a straightforward rent reduction on your space. At the very least, we recommend not pricing in the value of the assets that were left behind to remain competitive with bare office options that are still abundant in the market. In some cases, it can be more cheaper to consider a bare shell option, because for a existing space with existing assets, there's an additional demolition cost involved, especially if that asset is not usable to the next tenant. So, things like that have to be considered, and we really, landlords really still have to remain creative to be competitive. Next slide. In the flex industry, still the vacancy rates about supply led, mainly. In 2024, really supply led, from particularly to some select providers like Regus, who introduced a lot of centers in Metro Manila. In Metro Manila, in particular, they introduced about 865 new seats in various areas in the National Capital Region. Next slide. The market in the provincial areas are actually doing better than 2023. So we recorded 222,000 square meters of office deals in the provincial market. Compare that to 209 in 2023. But what's more interesting to us in 2024 is that demand is actually more distributed to more areas outside of the usual markets of Cebu and Clark. We've seen upticks in transactions in Iloilo, Davao, Bacolod, Batangas, Bohol. This also follows new office buildings that were recently completed, particularly in Iloilo. There's new office supply, and that invited also new office transactions or office demand in that area. Bohol in particular, one BPO's agility got space in a repurposed property because there was not a BPO grade office building anymore in the left in the particular region. So there's demand in the provinces, but it's not automatically being matched by BPO grade office supply. Next slide. Flex also Regis also introduced a couple of seats in new centers outside of Metro Manila. But the trend in Flex is also the same with uh, um, in the traditional office space. No, it's really we need more distribution for this type of product in more areas in the provinces because flex space or co-working plug and play is a good way for outsourcers or BPOs to test the market, do some recruitment before fully setting up in a location. So like an incubator, it's a way. It's really helpful in building a case to expand into the provinces. Okay, I think that's next slide. Okay, so that's the end of the office sector. Just to recap everything, no. So negative office demand for Metro Manila in 2024, 45,000 square meters. But it's not just about the POGOs leaving, but still companies are not renewing their pre-pandemic leases. But we have to point out here that you look at the transactions motivations and profiles. No, a lot of deals are all about expansions and setting up in Manila. So those are good things that feed into the positive net office demand that will feed into the office demand in this year in 2025. There's a lot of vacated space in the market, yes, but that also leaves an opportunity for tenants to start looking for good deals in the market. And landlords, we wish to be more take a proactive stance and be creative in maintaining the marketability of these spaces. Then lastly, provincial demand is high and exciting, but of course the supply needs to match the excitement. So that's it for the office sector. Thank you very much.
Thank you, Kevin. I know a lot of questions for office, so we'll be having a Q&A after the presentation of Joey. I think Jeff will be flashing the QR code for the survey before Joey starts, so we can flash it in between the reports. So everyone, please take time to scan our QR code. This is very important for us. Please do answer the survey. Very interesting results from the face-to-face yesterday. We will be flashing the results after the sectors that will be presented by Joey. Thank you. So Joey, are you ready? I think everyone's excited to hear about the residential, hotel,
Thank you.
Industrial segments. Turn it over to you, Joey.
Yes, thank you, Marie Chris. Can you hear me? Okay.
Yes, I can hear you.
Okay, thank you, Marie Chris. Great to see Marie Chris again after our face-to-face event yesterday. Just checking, Marie Chris, can you see my slides now?
Crystal clear, Joey.
Okay, thank you. So we were having technical difficulties earlier. Marie Chris, you need to stop watching your K-dramas for now and focus on the webinar because it's taking up a lot of bandwidth. But let me now focus on the Philippine economy, which grew by 5.6% in 2024. This is, still faster than the 5.5% we recorded in 2023, making the Philippines the second fastest growing economy in Southeast Asia, only behind Vietnam. What's interesting is that Filipinos continue to be deployed and send home money to their families, loved ones here in the Philippines. So about $34 billion in cash remittances $37 billion in 2023. And we are on our way to about $37 billion, $38 billion. So that's about 3 to 4% increase year on year. And there's an interesting piece on OFW remittances and their real estate allocation. So we will be discussing that later, and we believe that that is a low-hanging fruit for the property market, especially for the Metro Manila condominium sector. But speaking of the Metro Manila condominium sector, it is facing challenges at this point, mainly because of elevated mortgage rates. We hope that with the central bank aggressively cutting interest rates, we will be seeing lower mortgage rates moving forward. So let's see if that will kick in mid of 2025 or latter part of 2025. And of course, lower mortgage rates will be very beneficial and instrumental to the recovery of the Philippine property market. The land values are now dropping. So if you follow our reports, the last time we recorded drops were at the height of the pandemic, 2020, 2021, and then they recovered. But now, because of tempered launches in the Metro Manila residential sector, we're seeing record high office vacancy, as Kevin earlier reported, almost 20%. And we're seeing now developers really launching less in the market, whether it's office or a condominium building. And we believe that one of the major reasons why we see corrections right now in terms of land values is because of overall lackluster demand in Metro Manila, especially in these major business districts, including Makati, Fort Bonifacio, Ortigas Center, and the Bay Area. Of course, if you want to seek further clarification, you might want to get in touch with our appraisal team led by Paul Ramirez. Let me now shift to the residential sector. What we're seeing in the condominium sector in Metro Manila right now is that because of sizable unsold ready for occupancy units, we now see developers implementing more attractive payment terms, especially for the ready for occupancy segment. It's only one of the measures that they have been implementing so that they can be assured of movements within their unsold inventory. What we're seeing also is not just sustained, but even strong take-up for residential projects outside of Metro Manila. I will discuss that later, but we're now seeing more condo hotels, for example, that are being launched outside of the capital region already sold out. And that only indicates that we will be seeing more of these projects beyond 2025. What's interesting again for the property sector is that if you zoom in on the Metro Manila condominium sector, there is a positive impact brought about by the elections, especially the presidential elections. We saw that in 2010, in 2016, and of course, another 6 years after that, 2022. So interestingly, elections infuse a lot of optimism into the real estate sector. The question is, now that we're seeing challenges, will that be enough to resuscitate, revivify the ailing condominium sector in Metro Manila right now, which has about 163,000 condominium units and 70% of this supply coming from these major business districts, including Makati, Fort Bonifacio, as well as the Bay Area. Now, if you look at completion, fourth quarter of this year, 2,800 units. In 2024, about 7,700 units were completed. This is a 30% drop compared to our initial estimate of about 11,300. So right now across the capital region, if you look at 2025, there will be about 9,000, close to 9,000 units that will be completed. One concern here is that there will be relentless completion in the Bay Area, relentless because we will be seeing more, close to 60% of the new supply of the new units to be turned over will be coming from the Bay Area. So again, we're likely to see the stock of the Bay Area further increasing once these projects by Anchorland, SMDC are completed. Fort Bonifacio will cover 17%, followed by Makati CBD, Alabang covering 21% of the new supply this year. Now, if you have been following our reports, as you can see here, 2017 to 2019 was a very good year in terms of completion. Because at that time, we were seeing the completion of 13,000 condominium units in Metro Manila every year during that period. But because of slower launches, especially at the height of the pandemic, and then after 5-year completion, you now see less completion, turnover of units in the market. So from 13,000 units during the POGO period, we're now down to almost 6,000 units completed every year from 2025 to 2027. Look at 2027, only about 1,200. So if you compare that versus 2017, for that 10-year period, there will be a 92% drop in terms of completion. So again, if you have been following our reports, you would notice that there has been a meteoric rise in terms of residential supply for the Bay Area. If you recall our previous reporting for 2023, as of third quarter 2023, overall supply in the Metro Manila condominium sector grew by about 80%. In a single location, supply is perhaps skewed towards a single business district, and that is the Bay Area, where supply from 2016 up to 2024 grew by almost 400%. As you can see here, the Bay Area outpaced the total number of units in Ortigas Center in 2018. It outpaced the total supply in Makati CBD mid of 2021. And this year, 2025, it will now overtake Fort Bonifacio. Again, the Bay Area used to play catch up, but by 2025, this year, it will dominate. If you look at 2024 here, and if you see that gap in between Fort Bonifacio and the Bay Area, we highlighted this because the Bay Area was in fact supposed to overtake Fort Bonifacio already in 2024. The only reason why it failed to overtake Fort Bonifacio is because of delays in certain projects in, of course, the Bay Area. So that will likely happen in 2025. Let's see if those projects are finally completed this year. So because of the POGO exit vacancy of the secondary residential market in Metro Manila has reached a record high, almost 24%. What's notable here is that the Bay Area even recording a vacancy of more than 50%. So again, if you recall our previous reports, the Bay Area's vacancy, we projected that to almost double from 26% to about 55%, mainly because of the POGO exodus. Somehow, the trend that we are seeing also in the office sector. So again, if you compare business districts, it is the Bay Area that is recording the highest vacancy as of end 2024 compared to the likes of Makati CBD, Bay Area, as well as Ortigas Center. Now, because of these rising vacancies, rents are declining and correcting. Fourth quarter of this year, a 0.3% rental correction, and for 2025, we're projecting residential rents to correct by 1.5%. It's the similar trend that we are now projecting for prices or capital values. In fact, prices dropped by 1.5% fourth quarter of this year, fourth quarter of 2024, and then for this year, that's about 1% price correction. So again, they are now treading that downward movement, mainly because of rising vacancies across Metro Manila. Reason why yields are low at this point. So 2013, that was a 7.3% yield in the Metro Manila residential market. A very good yield, very comparable compared to our competitive peers in Southeast Asia. But if you look at 2019, it dropped to 4%, and then 2024, again, 4.2%. So it appears that Well, right now, if you are an investor, you are definitely facing challenges. Will you buy a condominium unit and will you be able to rent it out at a competitive rate? As you can see right now, yields are very low in the market. But if you are looking for other investment options, of course, our capital markets and investment services team will be more than willing to help you. Now, if you compare secondary versus pre-selling prices, again, I discussed that secondary prices highlighted here have also been dropping. Whether you look at Makati CBD, Fort Bonifacio, or Rockwell Center. But what we are seeing right now is that prices in the pre-selling primary market continue to increase, mainly because these are condo units that are still within the inventory control of developers. So they are not keen on dropping these projects' prices. So they continue to increase. So the challenge now is if you are an astute investor and if you have the cash to dispose of right now, will you buy a pre-selling condominium unit in Rockwell at 554,000 pesos per square, or will you buy a secondary condominium unit that was completed years ago, but at a much lower price of 290,000 pesos per square meter? So this is one of the challenges that investors are facing right now. But of course, despite all these uncertainties and challenges, there will be opportunities. And again, we're seeing opportunities in the secondary market, especially as developers, including Rockwell, have also been providing extended down payment terms. In the pre-selling market for the condominium sector, this is a major challenge. Because if you look at 2024, only 9,000 units were launched or taken up. And then 11,000 units were launched. These are the lowest figures that we have recorded. Again, if you compare these figures versus 2018, 2019, at the height of the POGO demand, when developers were really ramping up their launches across Metro Manila, and essentially what is being launched during that time is also being taken up by the market. But this started to slow 2020, as you can see here, and then 2021 when we recorded the substantial backup, especially in the Bay Area. So the question now is, given that we see these challenges in the pre-selling sector, how is the condominium market doing right now? Again, I'll just give you a quick review. Back in third quarter of 2024, when we had our presentation, we said that it will take 70 months for the condominium units, the unsold condominium units, whether it's pre-selling or secondary, to be fully absorbed by the market. Now, this did not improve, unfortunately. In fact, it has gotten worse to about 98 months. So it will now take 98 months, 8.2 years to fully absorb the unsold, ready for occupancy, and pre-selling condominium units in Metro Manila. But let me highlight and explain that this 98 months or 8.2 years, of course, will vary because it depends on the take-up that we recorded over the past 12 months. For example, if you have your unsold inventory still at about 74,000, and then you have your take-up at about 10,000 units the past 12 months, easily that 8.2 will drop to 7.4 years. So it is not a static figure, meaning it can vary, it can improve. Unfortunately, it can also worsen, depends on the market situation. Now, when we look at the ready for occupancy inventory, right now, it will take about, again, as I mentioned earlier, much longer period for these to be absorbed by the market compared to what we recorded last time. But in terms of value, from about 90 billion pesos worth of unsold RFO units in Metro Manila, that has increased substantially to about 158 billion pesos. Again, just to provide context here, right now it will take 8.2 years for these units to be absorbed by the market. Previously, at the height of the POGO demand, it will take about 1 year, 12 months. But again, we're no longer seeing those figures. But if you look at the price segment, again, I want to discuss this because some brokers and broker groups are alarmed that we're trying to sow fear in the market. That is not correct because whatever we release is a data supported. But as you can see here, not all property segments, condominium price segments are affected. It's the mid-income, of course, that is seeing challenges at this point. About 60%, close to 60% of unsold RFOs in the market right now from the mid-income sector, 3.6 to 12 million pesos per unit. Of course, you have the lower mid-income also at 3.6 to 7, upper mid at 7 to 12. But if you look at the upscale and the luxury, starting at about 12 million a unit, this is performing relatively better because they cover only 5% of the unsold RFOs in the market. Of course, you can argue that there's not a lot of supply in the upscale and luxury segment. But I want to highlight, of course, that it's the buyers, investors of these more expensive condominium units that are awash with cash and can even buy their properties in cash. But it's the mid-income segment that has been dependent on bank loans. And unfortunately, of course, mortgage rates remain elevated. One of the major reasons why this mid-income segment is struggling at this point. The question is, if you go around Metro Manila, again, I want to dissect that question of uncertainties in the Metro Manila condominium market because not all locations are the same. Not all locations are experiencing challenges. Which locations, as you can see here, are experiencing huge number of unsold condominium units? They are Quezon City, Manila, Parañaque, Pasig. The other business districts that are doing well right now include Ortigas Center, Rockwell, Fort Bonifacio, and Makati CBD. In fact, their share to total unsold RFOs in the market are even below 1%. So again, much of these unsold RFOs are located in these locations in yellow: Quezon City, Manila, Parañaque, and Pasig. So I want to explain that further. The reasons behind the condominium oversupply. You can see here the reasons, but let's discuss each item. Well, prices have increased, of course, substantially since the pandemic. And as you can see here, from about 2017 to 2023, average prices of condominiums in Metro Manila increased by about 14% every year during that period. The question is, and this is the problem that we're seeing right now, salaries have also increased, but not as fast compared to the acceleration of average condo prices in Metro Manila. Then, of course, you have cash remittances, the money sent home by Filipinos working abroad. They continue to increase, but not as fast compared to the increase in prices of condominium units. So why are we seeing high condominium prices, high land values, elevated interest and mortgage rates, and of course, the surge in the prices of construction materials? I already discussed the first two items, but I want to zoom in on the prices of construction materials, which, as you can see here in 2022, reached a 14-year high. So while the index is declining, that is coming from a high base, meaning prices still continue to increase, but at a slower pace. So again, this is data from Arcadis. If you look at the price per square meter of construction of a high-rise condominium, as you can see here, increasing by 14% from 2018 up to 2023. So from about 89,000 pesos per square meter to build a condominium unit, that has increased to about 102,000 pesos per square meter. It's actually the same across the board, whether you look at other projects outside of Metro Manila, including residential horizontal projects. So again, we want to debunk the gloom and doom because there's a lot of pessimism being infused into the market right now. Some people saying that this oversupply will affect the entire Metro Manila, but of course that is not true. Again, I want to discuss this. Let me first touch on the ready for occupancy promos in the secondary market. So developers have been providing extended down payment terms. So from the initial 18 to 24 months for the ready for occupancy units, they have been extending this to up to 48 months. And of course, right now, if you look at certain completed RFO units, developers even provide up to 30% discount if you pay using cash, if you pay through spot cash payment. And again, right now, developers have been providing free air conditioning units, kitchen appliances, and other gadgets just to attract the interest for the RFO segment. Another major recovery enabler that we're seeing in the market is that developers continue to form joint ventures. So whether it's between two Filipino companies or Filipino and a foreign company, we're looking at these projects. And when we check their take-up rates, they are doing very well. For example, you have the likes of Haraya Residences, Robinson's Land and Shang Properties, Aurelia, Robinson's Land and Shang Properties, as you can see here, SMDC, Federal Land, DMCI, and Robinson's Land. These are 130,000 to as high as 530,000, 540,000 pesos per square meter for the likes of Aurelia. But they are recording very good take-up, ranging from 60 to 90%. But what we have also been seeing is that when they form JVs with foreign developers, these projects are also doing very well. So I want to highlight here the Velaris Residences between Robinson's Land and Hong Kong Land. You have the Grand Midori Towers by Federal Land and Oryx. So Arden Residences by Rockwell Land and Mitsui, Vista Land, of course, and Mitsubishi for Kizuna. And then you have the likes of Federal Land and Nomura for the Seasons Residences. These projects are, in fact, I would say some of the more expensive right now that we're seeing, but they are recording very strong take-up, 40%. And a couple of these projects already sold out. So only indicates that these JVs between Philippine developers and foreign players remain very attractive. Again, as I mentioned earlier, it's actually the upscale and luxury projects that are doing relatively better compared to other lower priced segments. In fact, developers have been launching more of these upscale and luxury, starting at 12 million pesos per unit. The total launches accounting for 41% in 2024, much higher than the 20% share in 2023. Again, I highlighted earlier that projects outside of Metro Manila remain attractive. And these are especially condo hotels that we're now seeing in Cebu, in Benguet, Palawan, Bohol, Samal, in Davao. And again, if you look at their take-up, they're recording very strong take-up rates, almost 60%. Some of them sold out already. And if you saw my first slide summarizing my residential presentation, I highlighted that the presidential elections, in fact, have a positive impact on condominium sales in Metro Manila. What's interesting here is that total condominium sales, in fact, peak a year after every president is elected into office. So that happened in 2011. Look at the jump in condominium sales, 131 billion to 155 billion. 2016, when President Duterte was elected into office, that's from 181 billion to 257 billion pesos. Of course, you may argue that during that time, a portion of this demand coming from the POGO sector. But note that it's also the Duterte administration that allowed the visa upon arrival and the entry of more POGO players from CEZA, the transfer from CEZA to Metro Manila. 2022, again, well, condominium sales also increased. In fact, almost 40% from 162 billion pesos to 225 billion pesos in 2023. One of the major reasons why, if you look at each administration, prices increased again a year after they assumed office. So 5% growth during President Aquino, 8.3% after President Duterte was elected into office, and then 4% increase after President Marcos's election in 2022. Again, what I want to highlight here is that infrastructure will remain instrumental, pivotal in stoking demand in the Metro Manila residential sector. We always say at Colliers that infrastructure projects help raise land and property values. They help unlock the value of your projects, and developers have been following the direction of these infrastructure projects, launching, completing projects where these infra and public projects implemented by the government are headed. Again, looking at Metro Manila, let me first start with Quezon City and Bulacan. So Northern Metro Manila, as you can see here, you have MRT, LRT Common Station, MRT 7. Of course, New Manila International Airport in Bulacan. You have North-South Commuter Railway, the Metro Manila Subway, and NLEX SLEX Connector Road. So we also highlighted here some of the developers with upcoming office and residential projects. I just want to qualify this because of a lot of projects already located and completed in these locations. We cannot identify all developers located in those areas. So we minimized it by highlighting which developers have upcoming projects in these locations. So for office, of course, SM Prime, Ayala Land, Mega World. For condominium projects, Alveo, DMCI, Mega World, SMDC, Vista Land, Shang Properties, and New San Jose. Now, heading down South Ortigas, so of course you have MRT4, which will benefit the eastern part of Metro Manila, and then the Metro Manila Subway. This is interesting because, of course, Metro Manila Subway is the biggest infrastructure project ever approved by the Philippine government that is now up for implementation, and it will have 2 stations in Ortigas Center. So again, a very interesting project that will likely raise land and property values in Ortigas Center. Some of the developers that will benefit: Amber Land, Far East Holdings, Ortigas Land, Island, of course, Ortigas Land, Federal Land, Mega World, Robinson's Land, and Vista for residential projects. So when you look at Makati, Fort Bonifacio, again, as you can see here, major infra projects that will be completed: Subway, C5 South Link, NAIA redevelopment, and of course the SMC Group are doing a very good job renovating and modernizing this modern airport. So developers that will benefit here, among those that will benefit include the Pioneer, of course, Ayala Land, Alveo, Bamberton, and then for residential projects, Federal Land, SMDC, Robinson's Land, Shang, Ayala Land, Premier, Alveo, Arthur Land, and Mega World. You go down south again, Manila Bay Area. These are the projects that will have positive impact on landed property values in the Bay Area. Bataan Cavite Bridge, due to be completed 2028. LRT1 Cavite Extension Phase 2. And then the EI development again. So these are projects that will be completed even before President Marcos steps down, or even after he assumes presidency, meaning when he steps down, some of these projects are also lined up for completion. Now, in the Bay Area, as you can see, some of the developers that will benefit: SMBC, SM Prime, Double Dragon, Pacific Concrete Products, Eastfield Properties, TransAsia, SMDC, Anchorland, Asiana, as well as Mega World for the residential projects. Now, one of the strategies that developers have been implementing is to further tweak their development pipeline. If they are seeing slow take-up in Metro Manila, they are likely to launch more projects outside of the capital region. And as you can see here, One example is the MCI. Well, their project for these residences in Makati Fringe is recording a relatively slow take-up of 21%. That's about 21.5 million a unit. But when DMCI launched outside of Metro Manila in Batangas as well as Benguet, their condotel project in Batangas is almost sold out already. That's 7.7 million per unit. In Benguet, Moncelio Crest, this is about 10.2 million at about 280,000 pesos a square. And in fact, recording a much faster take-up, almost 60% compared to the take-up of Fortis Residence. So you can now see that it's not just in Metro Manila that they should be launching, but there are opportunities outside of the capital region, which supports the shift to suburbia that we have always been highlighting, even at the height of the pandemic in 2021 and 2022. So it's a matter of launching the right product, the right location, and with the right price. SMDC projects, Jade Residences, Makati Fringe, that's about 6.1 million a unit. Take up, well, 23%. But when they launched now residences in Pampanga, this was launched in 2022, 1,740 units, 3.2 million a unit, 10 towers. This is sold out already. Even their project in Laguna called Turf Residences, so that's about 998 units, 3.2 million a unit, and this is about 50% sold. Again, geographic diversification is very important, even in Bacolod, Iloilo, Western Visayas. So when Mega World launched in Cubao, New Manila, Duran Park, that's about 9.3 million a unit. But when they launched in Iloilo at about the same price per unit, that is about 40% sold, so much better than their New Manila project. And then their project in Bacolod called Herald Park Suites at about 7.3 million a unit. That is about 96% sold, so almost sold out already. Even with geographic and project diversification, one good example here is federal land. So when they launched Observatory in Mandaluyong, so that's about 12.1 million a unit and about 50% sold as of end 2024. But when they partnered with the Nomura Real Estate Group, so this is Yume at River Park in Cavite, this is lot only. So from a high-rise vertical condo, they launched a lot only horizontal, 51,000 pesos per square meter. If you look at the relatively similar projects in Cavite, this is one of the more expensive, but look at the price per unit at 17 million. But the take-up is pretty impressive at about 86%. So you can now see the diversification that we have been highlighting. While we are seeing slow take-up in Metro Manila, there are opportunities outside of the capital region. And if you look at these locations, it's not just in Luzon. There are opportunities in Bacolod, Iloilo, launching lot only, house and lot, as well as mid-income priced condominium units in Central Luzon, including Pampanga. What's also positive for the residential market in Metro Manila, not just in the capital region, but across the Philippines, the OFW's allocation on real estate requirements is in fact increasing. And this has been the highest that we have recorded since 2016, meaning about 13% of OFWs now allocating money for their residential real estate requirements, much higher even compared to 2020 as well as 2021, of course, because of the COVID-19 pandemic. One reason why we believe that the OFW segment is a low-hanging fruit for developers. One of the major reasons also why property companies have been mounting international roadshows, and we believe that there will be greater opportunities. For example, Singapore is one of the biggest markets of major developers in the Philippines, given its size. So again, these are the opportunities that we're seeing, not just within the Philippines, outside of Metro Manila, but also outside of the country. Our recommendation, well, developers need to continue implementing attractive payment schemes, flexible promos for their RFO units. They need to extend down payment terms, especially when we talk about pre-selling projects. And again, similar to what I stressed earlier, launch the right product with the right price at the ideal location. That is very important. Of course, if you want to further dissect the data and if you want Colliers to help you look for the ideal location and the ideal product to launch, our advisory services team can help you, which is headed, of course, by my colleague, Tim Theodora. Now, before we proceed to the hotel sector, I do encourage you to scan this QR code so that you can include or join us in our survey. We will be flashing the responses later. As Maricris mentioned, we got some interesting insights from our survey yesterday during our face-to-face event. And we will be compiling these results and we'll be releasing the results through a radar report. Let me now shift to the hotel sector, which has been seeing tremendous growth, especially if you compare the country. 2020, 2021, we were not allowed to go out. And that was 2 years wherein the hotel segment severely suffered low hotel occupancies, declining average daily rates. But right now, we are seeing recovery, mainly because tourist arrivals are increasing, although below the government's target. The supply for 2024 is lower than our initial estimate, mainly because of construction delays. And another interesting development for the hotel sector in the Philippines is that more foreign brands will continue to enter the country. Not only that, they have been locating in thriving emerging destinations, destinations that at first you won't think will be ideal for a hotel investment, but foreign players are now putting up facilities, even MICE, meetings, incentives, conferences, facilities in these key locations outside of the capital regions. The total arrivals in 2024 close to 6 million. This is higher than the 5.45 million that we attracted in 2023, and total arrivals, of course, is lower than the Department of Tourism's initial estimate or target of 7.7 million. The concern that we have here for our international tourists is that our base is narrow, meaning it's not as diverse compared to other countries in Asia and Southeast Asia. Look at South Korea, one country, one market covering 26% of our total arrivals. USA, Japan follow with about 23% of total tourist arrivals here in the Philippines. So when you look at data and further check the breakdown, the Philippines is lagging behind its peers when it comes to recovery compared to 2019 peak arrivals. So we have only recovered about 72% of our peak arrivals, which is 8.26 billion in 2019. If you look at our neighbors, Malaysia, Thailand, Singapore, Indonesia, Malaysia is a very good example here. In fact, more than recovered already their peak arrivals in 2019. Thailand at about 88% of its peak arrivals in 2019. Singapore and Indonesia, the same at about 86%. This is one of the major reasons why we have seen a drop in foreign arrivals. Chinese arrivals, of course, have come in trickles, and if you look at 2019, when we recorded the peak number of Chinese arrivals, that was 1.7 million. That is down 312,000 international Chinese arrivals in 2024. From a peak of 21% share, that is down to 5.3%. This is one of the market that the tourism department is, well, of course, planning and to attract to the Philippines because they want the Indian market to fill the void left by Chinese tourists. Unfortunately, we're not attracting a lot of Indian tourists that peaked at about 135,000 in 2019, only 79,000 tourists in 2024. Now, the Department of Tourism, the government, has been planning to attract more Indian tourists by, of course, streamlining the issuance of e-visas, in fact. And hopefully, that will help us attract and, of course, package other tours and package the Philippines as a very attractive destination in Southeast Asia. Again, our Asian peers, Hong Kong, Vietnam, Thailand, Malaysia, Singapore, have been attracting a lot of Indian tourists, ranging from 400 to a high of 2.1 million for Thailand. So if you just corner, say, a tenth of what Thailand has been attracting and add that to our total arrivals from India, that will, of course, significantly help the travel and tourism sector in the Philippines. One of the major reasons also why hotel occupancies have been on the rise, 64% end of 2024, so about the same hotel occupancy that we recorded in 2023. And this is still encouraging given that new hotel keys were completed during the period. The Bay Area continues to enjoy healthy occupancies. So while we see the Bay Area having struggles with office and residential leasing, especially with the POGO exodus, a lot of foreigners and Filipinos now visit the Bay Area. Well, we attribute this, of course, to the proximity of the Bay Area to the Ninoy Aquino International Airport, and that has been having a positive impact on hotel occupancies of accommodation facilities near Ninoy Aquino International Airport. Hotel rates have also been increasing. The only reason why they appear to be dropping is because of the peso's depreciation. So this is the trend that we're seeing right now. Of course, dropping average daily rates in US dollar terms, of course, make our hotels more attractive to foreigners, especially to American visitors. But overall, while we recorded drop in average daily rates of a combined 21% from 2020 up to 2021, we have more than recovered that because ADRs have grown by about 28% in second quarter of 2022, and we're projecting average daily rates to increase by about 3% in 2025. This is another concern that we have because it appears that while Filipinos have been skimping on food and non-alcoholic beverages, clothing, and footwear because of inflation, well, it appears that Filipinos are also starting to skimp on travel. And remember when we were allowed to go out 2023, that there was a substantial increase in travel, transportation, restaurant, and hotel spending. So let's see if there will be improvement moving forward. In terms of supply in Metro Manila, it's still Quezon City and the Bay Area cornering the completion of new hotels. So the Bay Area, you have your Grand West Side, which is marketed as the biggest hotel in the Philippines, Bay Prime Hotel also with 100 rooms. In Quezon City, you saw, of course, the opening of Ibis Styles, Hop In North EDSA, Solia North, the first five-star hotel in Quezon City, Citadines Roses, 185 rooms, and Arden Hills Suite. So the average daily rates in Quezon City ranging from about $30 to a high of $206 for Soler North. There have been delays in hotel completion, and one of the major reasons why we're raising our forecast for hotel room turnover in 2025 to 2,700. There will be about 1,600 new hotel rooms that will open from 2025 up to 2027. That is the average every year during that period. And the good news is that foreign hotel brands continue to expand in the Philippines. In fact, of the new hotels that will open, about 40% are foreign brands. So Makati CBD, of course, will see the opening of Mandarin Oriental along Ayala Avenue in 2027. You have Somerset, Radisson, also in Makati CBD, Citadines, Ascott, Banyan, Hotel Okura. Very aggressive expansion from these foreign brands. And why not? They see a lot of optimism, opportunities in the market right now, especially with the Philippine government setting its lofty goal of attracting 12 million tourists in 2028. That's why even if you go outside of Metro Manila, you see these giants, the major players in the hotel industry, locating in Pampanga, locating in Cebu. So you have the likes of Radisson Red, Park Inn, Hotel 101 also, but even the foreign ones, Intercon, for example, you have the likes of Sofitel in Pampanga, you have the likes of Mercure in Zambales. So we're now seeing these foreign brands locating even in the non-traditional tourism destinations or hubs. For example, Bukidnon, there will be a Dusit Princess. Cagayan de Oro, another Dusit Princess. Batangas, another Dusit Princess that will be brought in by the Torre Lorenzo group. But this is bad news that we saw. Boracay missing its 2024 target with arrivals dropping by 7%. The target for 2025 is 2.3 million from total arrivals of 2 million back in 2024. The domestic tourism continues to improve. As you can see here, total overnight travelers 55.3 from about 40 million in 2022. And in fact, tourism expenditures growing by 72% in 2023 compared to the year prior. Some of the key destinations include Cebu, Batangas, Rizal, Aklan, Pampanga, Davao, Camarines, Negros Occidental, which of course covers Bacolod, Benguet, and Cavite. Now, when we look at average hotel occupancies outside of Metro Manila, we have seen also very impressive figures. So if you compare Clark, Cagayan de Oro, Cebu, and how they performed at the height of the pandemic when they were essentially used as quarantine facilities versus 2024 when we saw, in fact, the revenge travel somehow waning. During that period, 2020, 2021, average hotel occupancy only hovered between 20 up to 40%. But as you can see right now, in these three major destinations, hotel occupancies have reached about 70 to 80%. One of the major reasons also why we see developers such as SMX, for example, aggressively expanding and building convention facilities. And then you have more international events, and hopefully we attract more of those so that we attract more foreign tourists that will be staying longer in the Philippines and will eventually be spending more. These foreign brands continue to bet big on Philippine hospitality and have been partnering, some of them forming joint ventures with Philippine developers. The Department of Tourism has been very aggressive also in implementing reforms, in fact, highlighting golf tourism, which of course Santa Lucia Land has been maximizing. And I already saw a lot of ads placed by the government on CNN, and those are very beautiful ads. And I hope that those ads eventually attract more foreign tourists to the Philippines. Unfortunately, Maricris doesn't watch CNN, but this is one reform measure that we see having a positive impact on the Philippine property, especially on the hotel sector, because the land lease extension is currently pending on third reading. It has been approved on third reading, both chambers of Congress, House and Senate, and this essentially extends the lease for private lands from 50 plus 25 to 7 to about 99 years. What's interesting is that this land lease extension reform bill is a priority of President Marcos, a key reform measure supported by the president. That's why major foreign players are now looking at the Philippines, including this one, Four Seasons, because we heard that Four Seasons to invest in a country, they would require longer land lease term. In fact, it's the first couple that broke the news that the Four Seasons brand is now looking at the Philippines and might expand here in our country. So for the hotel sector, definitely there's a lot of interest for MICE facilities, meetings, incentives, conferences, and exhibitions. If unfortunately you were not able to join us yesterday, but that event was packed to the brim, about 150 face-to-face attendees, excluding Colliers staff. And one of the key reasons also why we believe that hospitality will be a major and attractive REIT asset moving forward. So there are challenges with office, there are challenges also with other segments, but the hotel sector continues to grow. And we believe that with the entry of more foreign brands, we are on our way to further exciting local and domestic travelers, especially the long haul travelers that will be coming to the Philippines. And I will be discussing this later for the industrial sector, but you're now seeing more high profile manufacturers coming to the Philippines. So when they go to the Philippines, of course, these are C-level executives, they are discerning, and they will be required, they would want to stay in high quality accommodation facilities. Again, one of the key reasons why we're attracting all these major international brands investing in our hospitality sector. Golf tourism is being aggressively promoted. So top of mind, you have the likes of Santa Lucia, the Villar Group, Mega World, the Rockwell that are taking advantage of this golf tourism initiatives of the government. And of course, build better more. Whatever you call it, build of the Duterte administration, or build better more right now. Improved infrastructure connectivity will play a crucial role in attracting tourists. Of course, if we want to attract throngs of foreign visitors, we want to make sure that we'll be able to accommodate them. So having a ramped up, a revised, and modern infrastructure will be key. So before I proceed to the industrial sector, which will be my next or my last presentation, I hope you scan this QR code so that you can join our survey. Again, we will be providing insights after our presentation and look at your responses. As Maricris mentioned earlier, we garnered very attractive, very interesting insights, responses from our previous survey that was held yesterday during our face-to-face event. And again, we will be compiling this and we will be coming up with a radar report. I understand that some developers, in fact, use those survey responses as references, some of them asking me for further details after we release our survey reports. But now looking at the industrial sector, well, Central Luzon has been attracting a lot of high-profile manufacturers. We're seeing greater demand for modern, sustainable warehouses, sustainable industrial parks. The Philippines manufacturing capabilities, attractiveness have been improving. In fact, we are seeing continued rise in our purchasing managers index, which is a very good barometer for manufacturing operations. So vacancies for warehouses about 12.8%, the lowest, of course, in Metro Manila, Southern Luzon and Central Luzon, about 14 to 15%. So you now have these major locators, especially in Cavite, Laguna, Batangas, so electronics, data center companies, those into pharmaceutical and other consumer products aggressively locating. And there will be new industrial supply from 2025 up to 2027. Name it, the major players have it and will further expand. Robinson's Land, the Ayala Land Corporation, Science Park, First Philippine Holdings of the Lopez Group, Aboitiz Infracap, and of course, Science Park of the Philippines. Hermosa Ecozone Industrial Park in Batangas, its expansion, 220 hectares, and it will feature residential, industrial, and commercial facilities. SPPI will be developing an industrial park in New Clark City, another thriving location up north, and the total land area is 100 hectares. Look at the initial investment, that's 30 billion pesos. And this industrial park, of course, will accommodate companies into food production, textiles manufacturing, automotive parts manufacturing, electric vehicles, semiconductors, and even data centers. PMI has been increasing steadily for 2024, as you can see here. And in 2024, we recorded a PMI, Purchasing Managers Index, of 52.1, higher than the 51.8 that we recorded in 2023, and much better than the COVID-19 affected PMI in 2020, which was only 46.6. Now, these companies continue to expand. Whether you look at Central Luzon or Cavite, Laguna, Batangas, I want to highlight here that the profile of manufacturing locators that are heading up north and Central Luzon, their profiles are improving. The Central Luzon industrial parks are now attracting the higher value manufacturing locators. As you can see here, VS Industry, which leases in Ayala Lands Logistics Facility. This is in Santo Tomas, Batangas. Total area is 2.7 thousand square meters. This one here is a major player in Pampanga. So this is in Teco Industrial Park. This is Shira, which manufactures fiber cement. Total initial investment, 2 billion pesos. So while we saw the closure of James Hardy in Calamba, Laguna, we now have a counterpart in Central Luzon, in Pampanga, and Shira is aggressively locating in the region. Promet Asia is also investing in Teco Industrial Park. This is the largest steel and safe manufacturer in Europe. So as you can see, they are locating in Teco. Teco previously was known to house the largest paper manufacturer in the country, which is TEPCO. But you now see this high-value manufacturers heading north and are investing billions of pesos and are generating a lot of jobs. GFRP Philippines is also locating in Bulacan. This is the country's first manufacturer of glass fiber reinforced polymer. St. B, a gigafactory. This is a manufacturer of electric vehicle batteries. Of course, EV, as I would always highlight, is a sunshine industry of the Philippine industrial sector, and it will be investing more. Initially, they invested in Philinvest Innovation Park in New Clark City. I believe that there are plans to expand in Central and Southern Luzon. LCS, Emon Commercial Corporation, is also under the EV sector and will assemble e-jeepneys, e-minibuses, two-wheeled EVs, as well as three-wheeled electric vehicles in Malabar, Batangas. Lima Estate will be welcoming 13 incoming companies with those that will be manufacturing plastic molds, dental products, packaging materials, as well as solar panel components. NDC also, by the government, a state-led corporation, is also expecting 3 new locators. They have yet to be disclosed, but total project investment is 343 million pesos. Of course, Robinson's Land Logistics is also putting up its state-of-the-art facility and in Calamba. So that's 39,000 square meters total floor area, and known locators here, Shopee as well as Robinson's Supermarket. We remain hot on cold chain sector. In fact, the Frabel Group, Ayala Land Logistics continue to expand and corner demand for the cold chain sector. There's a proposed measure in Congress right now which calls for the establishment of a cold chain facility in every region. And we only expect developers to take advantage of this growing demand moving forward. So these are the, of course, reform measures that will have a positive impact on the industrial sector. Ease of payment of taxes, because we want to attract more foreign investors. We want to make sure that when they invest here, it's easy for them to register business and also pay taxes. Create more by providing more attractive incentives that are competitive with what our ASEAN neighbors provide. Make it easy for them to register businesses through green lanes for strategic investments. The U.S. CHIPS Act, allowing the Philippines to corner chips manufacturing that can be outsourced outside of China or Taiwan. And of course, land lease extension. When you talk about manufacturing investments, you're talking about billions of dollars of investments. Texas Instruments allocating $2 billion or $3 billion for its facilities expansion in Clark and Baguio. So looking at these investments, they are massive. So if you are a foreign investor if you infuse so much capital in the country, you want to make sure also that you are there for the long haul. So you need longer land lease terms. So we believe that this is a plus for the Philippine industrial sector. And again, as I highlighted earlier, the Luzon Economic Corridor remains an attractive destination for manufacturing locators. You have the likes of Clark, Subic, and then the proximity to Manila International Airport, Ninoy Aquino International Airport. You have the North-South Commuter Railway, NLEX, SLEX, Port of Manila, as well as Port of Batangas. And we believe that beyond 2025, this Luzon Economic Corridor will remain attractive for electronics manufacturers, EV manufacturers, even those that are into food processing or consumer goods. So it's very exciting time ahead for locators that are within Central Luzon and Southern Luzon, including for their residents. And given the government's massive infrastructure push, this is one economic corridor that we believe will greatly benefit from the projects being implemented by the government. When you look at REITs right now, is it time to rethink REITs? Well, yields right now at about 6 to 9%, as you can see here. But given that we're seeing challenges in the office sector, and then we're seeing retail rents increasing, mall occupancies growing, hotel occupancies more than 60%, average daily rates also rising by more than 20% since we recovered from the pandemic. It's probably time for developers to start infusing more of these retail, hotel, and even industrial assets into their vehicles, given that we're seeing challenges in the office sector. But I want to highlight here that when you look at other countries in Southeast Asia, there are some economies that are in fact infusing other asset classes, the likes of business parks, for example, or senior assisted living in Japan. So these are very interesting assets to be infused into REIT companies. And who knows, we might see similar infusions in the near future. So I just want to highlight here the property cycle. And of course, residential office sector is experiencing challenges. If you look at residential sector, record high vacancy in the secondary market, record high vacancy for office. One of the major reasons why prices have been correcting for condominiums, and then lease rates for offices have also been dropping, especially from 2020 up to 2024. So they are under pessimism stage at this point. When you look at the more optimistic sectors, including hotel and retail, well, rents have been increasing because for retail, for example, the retail mall occupancy in Metro Manila at about 15%. And that is the last recording that we have as of third quarter 2024. But note that there's no substantial increase in vacancy despite the completion of close to 100,000 square meters of new retail space during that period, during the past 6 months. So that only indicates greater retail space absorption. A lot of foreign retail brands are coming to the Philippines, IKEA, Nitori, Anko from Australia. And it will be a more exciting retail sector moving forward. As I mentioned in my previous presentations, the retail sector in the Philippines is becoming more experiential and less transactional because developers want the mall goers to stay longer within their retail centers and spend more. It's the same situation for hotel, wherein we now see rising average daily rates, occupancies more than 60%. Of course, we want to see hotel occupancies in Metro Manila reaching the 70% mark, especially once we attract the record high or even beat the record high foreign tourists of 8.26 million in 2019. Again, the Philippine government has been setting lofty tourist arrival goals, 12 million in 2028. One of the major reasons also why we see a lot of foreign brands proliferating in the Philippines. Industrial sector is one segment that has remained resilient, that has been growing steadily, even at the height of the pandemic in 2020, 2021. But somehow, because of increase in warehousing supply, for example, we're now seeing also the growth of rents slowing. They are still growing, but at a slower pace compared to what we saw even at the height of the COVID lockdowns in 2021 and 2020. So it's interesting to sum up the property cycle at this point. Where are they located right now? And if you are an investor, what will likely be your next investment or major purchase in 2025 or even beyond 2025? Of course, that's a very interesting decision. But again, we're here, of course, to help you. Our capital markets team can help you pick the right investment options. If you want to further dissect the property, our advisory team can also help you look for the right location, the right product to launch. And if you want to appraise and put a value on your properties, our valuation team, of course, will be more than willing to guide you and provide appraisal reports. So before we end the presentation, again, I ask you to scan this QR code and respond to our survey. And before I call on my colleague, Maricris Sarino, for our Q&A. Of course, Maricris is ready with some of the questions already sent in before our live webinar, and some of those questions were sent in during the registration of our participants. But before that, I also want you to look at our social media platforms. We're on LinkedIn, Facebook, Instagram, Twitter, which is now X, and Colliers Philippines on YouTube if you want to check out Maricris's previous ANC interviews and want to see her dish out sustainability related responses on the office sector. Please check out our videos on YouTube. So that's Colliers Philippines. Please give our Colliers Philippines page a follow. I assure you, you will learn a lot. So that concludes our presentation. And now call on my colleague, Maricris Sarino, to facilitate our open forum and Q&A. Chris?
Thank you, Joey. Job well done. Very comprehensive. We've been receiving a lot of questions already. But before that, let's call in our panelists. First, our Managing Director, Richard Raimundo, Executive Director and Head of Office Services, Tenant Representation, Domandaya, Senior Director of Capital Markets, Investment Services, Julius Guevara, Tim, Senior Director of Advisory Services, and Paul Ramirez, Senior Director of Valuation Services. So let's start with the bright spots. So Julius, this is for you, industrial sector from Jose Carlos CMI. What are the fastest growing areas, markets for warehouses and cold storage?
Okay, for warehouses, it's mainly driven by the growth in e-commerce that we've seen over the past few years. And that's still being driven by the urban areas, right? So our e-commerce tenants, they usually look for locations in and around Metro Manila. So, Cavite, Laguna, Bulacan, Pampanga. So those are the areas that they're keenly looking at, as well as in Metro Manila for their last mile deliveries. Particularly for cold storage, what's critical to them is also similar. They have to be close to the urban areas. They look for properties near the major roads. But of course, because of the pricing, and they're competing with, commercial values and residential developments, etc. They're a bit more price sensitive. So, they could be a bit further out, but they have to be close to the highways. So I think that's
another question from Nestor Lim, Philinvestland. Are the upcoming local elections impacting the industrial sector? Why or why not? Will the upcoming election have an impact on the industrial sector?
I don't think so. I've never seen that, historically. probably the residential and office sectors. Those that are more investment related would be more susceptible to that. But manufacturing and industrial, it's really consumption driven. So as long as the economy is doing well, and it's also manufacturing related, export oriented. So if there are threats, like for example the tariff wars that we're now seeing in the US versus China, Canada, and Mexico, and if you read the news and the analysis of like other economists, we are not as susceptible. We're kind of insulated from that problem. So I think we're gonna do well. So in terms of elections, I don't think it's gonna affect us as much.
Thank you, Julius. For Tim from Gilbert Bueno Pacifica Homes, how can developers address the condo oversupply in Metro Manila? Does the oversupply affect the Metro Manila residential market only?
Well, the developers are already doing as much as they can to make their products more affordable, given that the market is still in recovery. They've offered extended payment terms, and they've also given more discounts. As we've seen, the discounts have increased to 30%, extended payment terms up to 72 months. And I think those have helped move sales in the market. But also developers have to be careful also that when it comes to time for turnover, that the buyers that they have are also able to pay for the amortizations upon turnover as well, because sometimes that's where the dropouts happen, or the cancellations happen at that stage. In terms of oversupply in Metro Manila, so most of the oversupply is really in the mid-income segment, and it's because, as mentioned earlier, there's a disconnect in terms of pricing in Metro Manila versus affordability. But when you see in the horizontal development, especially house and lot developments outside Metro Manila, the take-up is relatively stable. There was some drop, but not as much as we've seen in Metro Manila. Maybe 15%. Overall take-up was dropped a little in the provincial areas, but we can see that it's still the economic and affordable segments that's really driving sales, and that really goes to show that the demand for the more affordable end user market is there.
Tim, a follow-up question from Theodore Tardesilia, Land Excel Consulting. With indicators dramatic rise from 31 months in 2014 to 82 months, or nearly 7 years inventory by 2024, increasing risk premium to almost 23% plus extended payment terms without equity from buyers. Are these signs of a recession?
Maybe I'll turn over that question to Joey for that particular question.
I think Joey's drinking water. He stepped out.
Take that on. I don't think it's really immediately a recession. It's a correction. I think that's the better term for it. And I think as Tim has mentioned, it's not across the board. If you look and if you dissect the data, there are areas wherein the problems are bigger than the others. You look at areas, let's say Makati. Makati actually has a lower issue in terms of the inventory life. So let's not generalize. While the calculation right now is very high because the denominator went down, there are areas which are faring better. And I think, and as I've said yesterday, I think you have to look at certain things that should help the denominator or the take-up go up. Interest rates are starting to go down. It's not yet as low as pre-pandemic. That's the issue. But as it starts to go down, then that would help. And then in terms of the payment terms, I think that's easing as well. There are payment terms which are very conducive right now. Price itself has gone down to help with affordability. So there are a lot of factors that should help to clear out that oversupply in the
Rich, a
unit.
follow-up question from Karen Garcia, Tycon
Sure.
Corporation. At what point will developers actually have to disregard payment incentive and actually just cut prices to sell condo units?
Well, I think prices are being cut. Not by all developers. There are certain developers that are more aggressive than the others. I guess it really depends on how fast that they want to clear the inventory. So there are some which are softly doing it by payment terms, lengthening the down payment period before the bullet payment. And for some developers, that actually helps. I've seen developers wherein they didn't really bring down the price. They stretched the payment terms. They were able to clear all of their inventory without even touching the high price. It was just the payment terms. And Tim is correct. You need to be very careful that you cannot bring down your payment terms and your prices so low that you're actually attracting the wrong market, wherein you're going to create another problem, which is backouts and returns. So you could just imagine, let's say if you bring down your down payments to a very low level, after 3 years, it just returns to the developer, then that's another problem. So we don't want that, right? I think it's happening. The prices are very attractive right now. And as I've said, if you are an end user, seriously look at the market at locations that you want to live in, because there are very good pricing and terms out there.
Thanks, Rich. In line with the cutting of prices for the office sector, Kevin and Dom, are any trends of price discounts promos given by landlords to tenants given the all-time high of vacancy, especially on the POGO vacated spaces?
Yeah,
From Flor
definitely.
de Sousa Philindesan.
Okay, thank you. Yeah, definitely price reductions or rental reductions is a very straightforward way to enhancing marketability of your space, especially if that space is previously vacated and has existing assets that may or may not be usable to the next tenant. But more than commercial offerings or improvements in commercial offerings, I would really encourage landlords to explore non-commercial strategies like for refurbishing, reinstating the space back to commercial if that's the client's one. Even we've also seen some landlords even going as far as restocking their building tenancy if they can to accommodate particular occupier requirements so that they can win the business. So, pretty aggressive, but also pretty creative, no? A common concern right now with getting office space, given the cost pressures that we have not just locally but globally as well, is the fit out investment. So anything that the landlord can do to participate in helping support fit out, because it's really a barrier to entry to your building, would be really helpful to incoming tenants. So refurbishing, even participating in the fit out, replacing carpets, replacing AC, a lot of things really. In case to case, I would say. And, Richard said not really, let's not generalize that. Let's do it for all markets. No, there are some markets that are faster moving than others. So at the very least, we would recommend if there are limitations for the landlord to participate or to give some support, at the very least, don't price in any existing assets in your rent to make it more expensive, because you're still contending with the virtual options that are abundant in the market.
We have another question from Rohit Ravula. I can also chime in after your answer. In the office segment, when you mentioned about the growth of existing spaces trying to stay relevant in the market, what are the strategies that they are adopting? Can you delve on this
Oh,
briefly?
I mentioned those earlier, Sige, Chris, you can add. Pero really, just those creative ways to to do anything with the space to have tenants come in.
Yeah, I think for landlords that really have older buildings, it's really pivoting to greener policy. Ultimately, output is a step in that direction, opening spaces up to bigger and brighter, utilizing classic architecture. So for some of our buildings in Manila area, emphasizing on its history and beauty, fitting out classic buildings with modern technology while maintaining the art of its architecture. Lastly, for building owners, landlords, a sense of community in the building's tenants and personnel is really encouraged, like a lot of events to really encourage back to the office, and a sense of community within your building really helps a lot. So I think Joey's back. Joey, another bright spot is the hotel sector from your good friend Sheena Ubra. Ascott, what does the hotel and service residence industry headed towards, especially this year? What innovations are advantageous to the hotel industry?
Similar to what I discussed earlier, I think we're seeing more hotel brands entering the Philippines. These are foreign, big, major players. And interestingly, they are located not just in Metro Manila, but even outside of the capital region. Some of my examples earlier, Cagayan de Oro, Bicodnon, of course, more hotels in Cebu, Davao, Radisson Red, Sofitel in Clark, in Pampanga, and another Sofitel in Cebu. The Han Group, for example, has also been aggressive, partnering with players like Intercontinental as well as Novotel, and are building branded residences in Clark within the main Clark zone. So that is a very interesting development that we're seeing in the hotel sector. As I also highlighted earlier, this land lease term extension will be a boon to the Philippine hospitality sector, and we're only on our way to attracting more foreign hotel players, because we want to also raise our foreign brand penetration here in the Philippines. Unfortunately, at this point, it's one of the lowest in Asia. So we really want to wrap it up, and only way also to do that is to make sure that we have a more business-friendly regulatory environment in the country.
Joy, another from a question from a good friend of yours, BSP, Princess Ong. What is the outlook for the REIT and securitization markets in 2025? What are the factors that will drive performance?
Yeah, I sound like a broken record whenever I answer questions on REIT, but I think for REIT, diversification, of course, is very important. It is the name of the game, especially now that we're seeing challenges for the office sector. Lease rates are declining, vacancies are increasing. You now see the industrial sector, well, that was stable at the height of the pandemic because of rising vacancies for the warehousing sector. Lease rates are still increasing, but at a slower pace. So for developers right now, as we always say, is it time to rethink their REIT? And is it time for them to infuse other asset classes, including hotel, retail, of course, SM Prime already started off a major REIT offering that was about 2 years ago. But will it finally happen this year? That has yet to be seen. If that happens, it will be the biggest REIT offering in the market. So a lot of opportunities still for the REIT. As I also highlighted earlier, if you look at residential yields, they're not doing very well. They're not elevated at this point. So REIT is probably one of your best investment bets right now.
Thank you, Joey. For Paul Ramirez, do you think property prices, especially Metro Manila condos, will go down given the current oversupply? Will landowners be compelled to sell at a lower price to developers given the slowdown of new project launches?
Okay, I'll take the first question first. So I think Joey has elaborated on that clearly in his residential slide. So we've seen that the secondary market prices have already started to drop, and with that as well, the rental rate. So it goes to show that the values of residential condos are actually going down a bit slightly. On the, what's the second question? It's about the land, right?
Yes.
It's okay. For the land, yes, we've seen the sellers, the landlords are able to hold on their asset. They don't really have to sell. they're not leveraged as far as their ownership of the land, so they don't really are compelled to sell at a lower price. But also on the buyer side, they're not buying. They're not buying the high prices that the sellers are offering. So I think something has to give somewhere in the middle. That will be the value from the asking price to what the seller can actually afford. Given that the metrics right now, office performance is down, residential condo is down. So all the metrics are pointing to an adjusted or a corrected land value in the future.
Thank you, Paul. I think Joey's ready to flash the survey result. Thank you, everyone, for participating. I think the highest was 990 participants that joined us in Zoom today. So we're very excited to show the results of the survey.
Can you see the slides now, Chris?
Yes.
All that. Okay. Question number one, how are you reimagining the use of your existing office space? So 30% saying hot desking and collaborative spaces. Interestingly, it's a bit more mixed, equally balanced amongst these choices compared to our responses yesterday during our face-to-face event. Outside of the established business districts, Makati, Ortigas, Fort Bonifacio, and Alabang, which of the following locations would you choose for your next office space? Maricris one likes this answer, 33% choosing Makati Fringe.
A
Of course,
lot of
Makati Fringe,
premium green
you have the
buildings.
Makati Commerce Tower, Chris, right?
Yes.
One of the best buildings I've seen. So you might want to
And it
check
really
that
fosters
out.
community
And
engagement
correct,
in the
correct.
building.
And contact Maricris. Just use the code Joey Roy. What is your current work arrangement? Well, 100% return to office, similar to the responses that we called yesterday. A lot of our clients, partners now implementing 100% return to office, which should remind me that I should allow now Martin and Brent to report to office 100%. If implementing hybrid, are you planning to occupy flexible co-working space over the next 12 months? Oh, interestingly, 60% saying yes. In contrast to the results yesterday, wherein the no answers had it, meaning more of our respondents not keen on leasing out flexible or co-working spaces. So an interesting insight that we got from our webinar participants. Out of the established business districts, where are you likely to purchase your next condominium unit? Again, I want to highlight here, Chris, that the choices that we have here are the locations with the most number of unsold RFO. And as you can see, Makati's Fringe and Pasig covering close to 50% of total respondents. What will be your next residential investment? Again, 40%, similar to the top choice yesterday, choosing house and lot unit in North and South Luzon. Again, if you look at 2016 to 2023, Calabarzon and Central Luzon are two regions that really recorded escalation of prices for the horizontal segment, whether it's house and lot or lot only. Which of the following promos will likely lure you to buy a condominium unit in Metro Manila? 2/3 saying they prefer extended and flexible down payment terms. Again, this is essential, especially now that we have a lot of unsold condominium supply in Metro Manila, which extends to about 8 years. And as Richard mentioned earlier, for some developers that implemented extended down payment terms for their RFOs, they were able to sell those units out. So an interesting insight here, and hopefully developers also follow suit. Which of the following are, or where are you likely to travel over the next 12 months? Palawan remains the top choice, similar to our survey yesterday, but Boracay 22%, and then you have the likes of Cebu 15%, Bohol 11%. I don't know where Maricris is going, but I'm going to Bacolod to have inasal. What do you think is a fair trade-off for a 30% discount? 44% choosing room upgrade, and then followed by 41% choosing buffet breakfast. Of course, Marcus will still choose a buffet breakfast any day. So that concludes our survey responses.
Thank you, Joey.
All
It's 4
presentations.
o'clock.
So yes, Marie Chris. So we're
It's
gonna
4
call on
o'clock.
Richard
Rodel
for the
has
final
given me
remarks.
a heads up to wrap up. So thank you to our Colliers experts, Joey Bondo, Kevin Hara, Julius Guevara, Paul Ramirez, Tim Teodoro, Domandaya, and of course, Richard Raimundo for always shedding light to the current landscape of the real estate sector and providing us with useful insights and recommendations as we face promising months ahead. Once again, thank you all for attending. But to officially close our program, let's hear some final remarks from our Managing Director, Richard Raimundo.
Thanks, Chris. I'd like to thank everyone who joined us this afternoon. This is, I think, our biggest turnout for online briefing. While we gave the numbers for what happened in 2024, we also gave what to look out for in 2025. So it's not just a retrospect, but we are looking forward and we are looking at the bright spots. We are looking at opportunities in the market, in office, residential. Well, there are some softness in residential right now with the inventory that we have. It's good to really delve into the opportunities in the market. And if you do need anything for any of the sectors that we have mentioned this afternoon, please do not hesitate to reach out to us. And we can help you accelerate your success. So again, thank you very much and hope to see you in the next quarter. Chris?
Thank you, Richard. Thank you to everyone that joined us this Q4 2023 Philippine Property Market Briefing. Wish you good luck in the year of the snake, and we'll see you in our next briefing. Thank you, everyone.